Hey guys, Jessica here. So today I'm going to be talking a bit about crypto interest accounts and whether they're a good or bad idea. So you may have seen a bunch of these floating around. They generally advertise way higher interest rates than you could ever find in any savings account at a bank. And actually recently, Coinbase also announced that they're going to be offering one of these too, giving out a 4% interest rate. You've probably wondered how it's possible that crypto accounts are able to pay such high interest rates when savings accounts these days are paying peanuts. It's a good question because, as with anything in finance, risk and reward are always intertwined, and this is no exception. So, first, how they work. Crypto interest accounts basically work like banks. And at its core, what a bank does is it takes in money from depositors, so the money that's kept in checkings accounts or savings accounts, and then they take that money and they lend it out to individuals or companies. And they make money because the interest rates that they charge on the loans that they give out are higher than the interest rates that they pay out to their depositors. Sometimes these loans aren't paid back. Say if the company that took the loan goes bankrupt, then they're unable to pay back that loan. And in those scenarios, the bank takes a hit to their profitability. In really bad scenarios where a lot of their loans go bad, then the bank could even stand to go bust. In theory, that means that depositors could also stand to lose the money that they kept with that bank. And that's pretty much what happened during the Great Depression. Between 1929 and 1933, over 9,000 banks failed, and a lot of people lost a lot of money. There's this amazing scene in It's a Wonderful Life. And basically back then, whenever people got word that a bank might be failing, they would race to the bank to try to get out their money as quickly as possible.
Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run. Hey, lady, you got any money in the bank? You better hurry.
These runs on banks could even bring down healthy banks, and all it would take would be a rumor to get the whole thing to start snowballing. To protect people's money and to restore trust in the system, President Roosevelt at the time asked Congress to create the Federal Deposit Insurance Corporation, or the FDIC, and the FDIC continues to this day. Anyway, back to crypto interest accounts. Crypto interest accounts basically work the same way. So you deposit some money with them. In this case, it's a crypto asset like Bitcoin, or it could be a stable coin like USDC, and then they turn around and lend it out at higher interest rates. The thing is, though, crypto interest accounts aren't insured by the FDIC. And so there's still the risk that they go and make bad loans, that they go bust, or even that a run happens and you could stand to lose some or all of your money. On top of this, the underlying money that you're depositing is crypto, and the loans that they're giving out are also in crypto. And fundamentally, crypto in and of itself is a pretty risky asset. So, long story short is that you should think about crypto interest accounts as investments, not savings. If you think about it like an investment, then it may make sense for you and it may not. So this really depends on the returns that you're looking for, the risk that you're willing to take, as well as the overall structure of your portfolio and whether or not this makes sense in the grand scheme of things. The fundamental thing about an investment is that you need to be going in with eyes wide open. So both the reward side, but also the risk side. And my biggest gripe with these crypto interest accounts is that they advertise the high interest rates in these big letters, but they fail to really talk about what's going on behind the scenes. All right, after that, if you end up deciding that a crypto interest account does make sense for you, then it comes down to which player you should go with. So today we're going to be taking a look at two players. We're going to be taking a look at Coinbase's new account, as well as another big name in this space, BlockFi. All right, so I'm going to be looking at Coinbase first. They say here that they are offering 4% interest rate on just one coin, USDC, USD coin. And they actually go into a bit more detail in their blog post. So let's go over there. This is their blog post that they published when they first announced this product. This happened on June 29th. And they go into a bit more detail in terms of what they were thinking and what the benefits are to this product. And specifically, they talk about how the interest rates are 50x the national average of a traditional savings account, really trying to position themselves as an alternative. And I find that very misleading because, as mentioned, it's not insured by the FDIC. Ultimately, the risk is higher. And down here, they talk about higher interest without higher risk. That's still misleading because the money that you deposit with Coinbase is still at risk for Coinbase making bad loans and Coinbase itself going out of business. That said, Coinbase is a really big company. They have a $50 billion market cap at the moment with multiple streams of revenue. And so the probability that they go bust versus the probability that some of the smaller crypto interest account companies go bust is probably a lot lower. The other thing to remember about Coinbase is that they are a public company now. And so there's a lot of information available about Coinbase and the health of their business. If you just go to investor.coinbase.com, there's a lot of information in here about the size of the company, how much volume they have, and especially if you go to their financials, you can see all of the filings that they have with the SEC, and specifically you can filter for things like their 10Qs, which are quarterly update filings. You can also see things like their initial registration statement. You can see their S1 with a ton more detail about their business and how their business is run. And so these are great places, as you are evaluating your investment and trying to understand the risk. These are great places to check out. Another product here is BlockFi. I'm going to show you guys a little bit of what they're about as well. And so crypto interest accounts are actually BlockFi's core product. It's how they got started. And if you scroll down here, you can see actually that they offer a lot more crypto options. If you just click in there, you can see that, hey, you could deposit Bitcoin with them, you can deposit Ether with them, as well as what Coinbase was offering, you can deposit USDC. Then, if you go to their rates page, you can see the rates that they're offering for each of these cryptocurrencies. So, to compare with Coinbase for USDC, they're offering 7.5% up to 50,000 USDC, and then 5% after that. And then if you come up here, you can see that they also offer Bitcoin and Ether, and they offer a tiered interest system where they offer 4% up to a certain limit, then 1.5% after that, and then 0.25% after that. If you scroll down, you can see, though, that they actually have some not so great fees. They offer basically one free withdrawal each calendar month, and then any additional withdrawals will be subject to fees. So definitely something to keep in mind with BlockFi. The other thing about BlockFi, though, as I mentioned with Coinbase, Coinbase is public, so all of their financials are publicly available for anybody to check out to see if, hey, Coinbase is doing well as a company. BlockFi is not a public company, and so generally speaking, those financials would not be publicly available. But if you go to BlockFi's FAQs, they actually have an FAQ article that talks specifically about the risks of BlockFi. And in here, what's great is that you can see that they are publishing their financials as of March 31st. And they talk about where they keep the money that is deposited with them, as well as a little bit of more detail in terms of the status of their loans and how much has been given out. And so between the two, I actually think BlockFi has a better offering. They have been in this space for longer, they have higher interest rates, and they're more transparent in terms of how they go about, making this business work. But I'm going to come back to the point that all of these things are investments, not savings. And so only go down this path if it makes sense for your situation. And that's it. If you want us to take a look at your specific situation and how to optimize, sign up on our website. It's linked in the description below. We do it completely for free. We are a startup on a mission to take the tax and financial optimization strategies of the rich and make it completely free. Other than that, if you got value out of this video, please hit the like button and subscribe for more optimizations. Thanks.